Hey everybody, welcome back to the show. So this is the first video of 2025, and so what I thought I'd do is sort of walk through some of the steps I take at least once a year to evaluate my investment portfolio, kind of make sure I'm on track, make sure there's not anything I should be doing, improving it in some way. And so I want to walk through 10 things that you might think about doing as you evaluate your own portfolio. Certainly these aren't the only 10 things that might be smart to evaluate or look at, but there's certainly 10 of, I think, some of the more important things that we need to make sure that we take care of. So let's dive right in. By the way, I will show you a number of tools as we go along, and we'll link to everything below the video. So the first two actually kind of go together. You know, you often hear once a year you should rebalance your portfolio. I actually received an email from a viewer just earlier today saying, should we rebalance, annually or maybe just as needed? I tend to rebalance as needed, although I do find that tends to be about once a year anyway. I do think it's a good habit at a minimum to at least check your portfolio and to, once a year to see if you should rebalance. And you say, okay, Rob, I get that, but why are there two steps involved here? And it's because I think step one is to actually write down, that's right, on a piece of paper, could be a spreadsheet somewhere, what your actual asset allocation is. That's what we're going to compare your portfolio to. This is, you've got your plan, and I think it's just important to write it down. Now, I mentioned, you could do pen and paper, you could do a spreadsheet. I will show you this spreadsheet that I put together. Longtime viewers know it. This is just the article. I'll link to it below the video. But you can get to the spreadsheet here. In fact, I'll just click the link. This is in Google Sheets. It invites you to make your own copy. So just to be clear, I will not have access to your spreadsheet. Only you will, or anyone you give access to. So if I make a copy of this here, this is all just generic demo data that I've put in. I added just a little net worth tracker on the first tab. But what you can do is you can list all of your holdings, and this ticker will populate the name of the, if it's an ETF, mutual fund, or stock, the name. It also populates the price. So for example, if I change this Berkshire to, I don't know, let's change it to Tesla. It changes the name, changes the price, and so on. So change it back. But so you can use that to input your portfolio, including the different account names. And then what it will do is aggregate it all here by asset class. And this is where this is just one way of documenting what your plan is. And it's under this target column. You can put what your target is. Again, these are just examples. And then it'll pull in data from all of this. You have to set the category, the asset class here. And then it'll pull in all of that information and show you, okay, your target's 25%. Here's the actual, in this case, heavy US stocks. And it'll even tell you how much you need to sell, or in some cases, if you need to buy, how much you need to buy to bring your portfolio back into, make it consistent with your plan. I have been wanting to update this spreadsheet for a while. That is one of my 2025 goals, but even as it stands now, I think it does a good job. And frankly, this is one of the tools, probably the primary tool I go to when I'm thinking about, do I need to rebalance or not? So that's sort of steps or 1 and 2. Write down your planned asset allocation and then evaluate it to see if you need to make any changes. Okay. Number 3, we do want to evaluate whatever individual investments we own. I always like to make sure that I'm keeping my fees as low as possible, but also, you want to make sure you have an understanding of what the investment covers in terms of your asset allocation. Sometimes it's sort of obvious. You invest in a, total US stock market index fund, and there you go. It covers US stocks. But sometimes, particularly if it's an actively managed fund, it can be a little more complicated. And some funds cover multiple asset classes, and some might include both fixed income bonds and stocks. And so you want to understand and make sure you know what each of your investments, why it's there, what it's doing, how much it costs. Probably the best tool for that, and it's free, is Morningstar. I had actually just typed in here ARK's ticker. That just happens to be a fairly well-known actively managed ETF, not a particularly good one, I might add, certainly not one I would invest in. But just to sort of as an example, you can see the expense ratio right here, 75 basis points, 0.75%. For me, that would be way too much money. I don't think I have any funds that are more than about 10 to 20 basis points, 0.1 to 0.2, and most of them are well below 0.1. But you can see the expense ratio here. You can also go into the portfolio tab and you can see what it invests in. You can see here most of it's U.S. equities, stocks, right? And then there's some foreign stocks, and that is pretty much the entire ETF. You can look at, by the way, look at the price earnings, 50. That's crazy. Anyway, you can come down here and you can see its top 25 holdings. So Tesla's its largest holding. So you can see what specific companies, if it's a stock ETF, what it's investing in. And so Morningstar is just a great, I think, free resource to drill into each individual investment to make sure you understand what you own and how much it costs. All right, that's number 3. Number 4 is asset location. All that means is what investments do we want to hold in taxable accounts? What investments do we want to hold in traditional retirement accounts like 401ks and IRAs? And then what investments do we want to hold in Roth 401k and IRAs? And I would put HSAs, health savings accounts, in that same category. And as a general rule, this is how I approach it. I want to try to avoid investments in my taxable account that are going to trigger a lot of taxable income every year. So that would include, for the most part, bonds, REITs. If I were investing in some sort of high dividend yielding stock or stock fund, I'd prefer to keep those out of my taxable accounts because they're going to trigger a lot of taxes every year. And then between Roth and traditional, generally my only rule is I want stock ETFs in the Roth accounts. I want to grow those as much as I can because they're tax-free. And then in traditional accounts, stocks are certainly fine, but I also tend to hold most of our bonds and fixed income in traditional accounts. They're going to be shielded from taxes, at least until I take the money out. And yet it's not going to grow as much as a Roth, but that's okay because the Roth is tax-free and the traditional is not. Plus, traditional IRAs and 401ks are subject to required minimum distributions. One question you might have is, well, how tax efficient is a given investment? We can go back to Morningstar for that. As a general rule, at least with stock ETFs, if it's an index fund, generally it's going to be fairly tax efficient. But you shouldn't assume that. One of the tools I like to use, again, going back to Morningstar, is to go to the performance tab here. And that's going to tell us how the investment has performed over a certain amount of time. You can see here's when ARK really went up, but then it sort of crashed and never really rebounded. But the tab here that I want to focus on is this distribution tab here. This shows you if it's distributing any income. So that would be a green part of the green bar would be income, and for a stock ETF, income would mean dividends, right? If it's a bond mutual fund or ETF, it's going to be interest. So in this case, it's dividends. And then yellow, by the way, return of your capital, fairly uncommon, at least for the kind of investments we talk about on this channel. But you can see short-term and long-term capital gains are the blue, and that's really what I want to avoid in a taxable account. And you can see there's been quite a lot of that with ARK. So not only has ARK been a very poor performing investment, it's been very tax inefficient. So it's sort of a double whammy to the extent you hold it in a taxable account. But in any event, you might find that tool helpful in evaluating your investments, to see if they're suitable for a taxable account. All right. Number 5, really important. Every year I want to go through and make sure, have I set beneficiaries and perhaps secondary beneficiaries for each of the accounts? Has my wife done that? And exactly who you're going to set as a beneficiary obviously depends on your circumstances. Perhaps you're talking with your trust and estates lawyer, because sometimes you set a trust as a beneficiary or secondary beneficiary. As a general rule, at least for us on retirement accounts, I'm always going to list my wife as the beneficiary on mine. She's going to list me as the beneficiary on hers, because there are some real advantages when a spouse inherits a retirement account as opposed to a non-spouse. But again, what's going to be best for you is going to just depend on your circumstances. But the important point is to make sure you've got them set. So literally go through every account and make sure you've got not only a beneficiary set, but the right beneficiary. All right. The next one, number 6, I think, if I haven't lost count, is performance. How well are you doing? And here, I actually kind of want to cover 2 things. I mentioned just a minute ago evaluating your individual holdings, and before that, rebalancing. So sort of the performance, how you've performed over the last year, sort of brings all that together. But I did want to show you one more tool that probably goes more into the category of analyzing your individual holdings before you get to performance. And it's this fund overlap tool. I'll link to it below the video. But you can put in 2 tickers. We'll just do VTI, and QQQ is a tech fund. And it'll show you there's 44% overlap, and it gives you details, including some by specific holdings. This can be a useful tool to evaluate your own portfolio. And if you have an advisor and they've come up with your investment approach for you, a lot of times I see advisors with 10, 15, 20, or even more investments, totally ridiculous. And if you actually use a tool like this to evaluate them, what you're going to likely find is that there's a lot of overlap between a number of the investments, and it just raises a big question. And it's a conversation you can have with your advisor. Hey, what's going on here? Why do we need this complexity? I personally don't think you do, but you'll have to make that decision for yourself. But even if you're managing your own portfolio, this tool can come in handy. And so once you've scrubbed all that, you figured out all your individual investments and your asset allocation and rebalancing, I think it's just good to say, hey, how have my investments performed over the last year? One tool to do that is Empower. This is a demo account. It's free, and it's a great tool. I've used it for more than a decade. And this particular portfolio is a 3-fund portfolio that I manually entered in. And over the last year, it returned 13%. Now, stocks were up a lot more than that, but this includes fixed income and international. And I don't actually even remember. Let's look at the allocation. So U.S. stocks are only 50% of this particular portfolio. Again, I just threw this together. So that explains why it underperformed the U.S. market in 2024. I'm looking at, let's make sure. Yeah, I'm looking at the last year. You can look at it, 90 days or what have you. You can also exclude accounts. If you've got multiple accounts, you just want to zero in on some accounts. And as I said, you can look at the allocation, balances by, we can go drill down, holdings. You can look at the balances by holdings, which is helpful. In fact, when you think about your asset allocation, we often think about the asset class, but at the end of the day, it may be easier to think about it by specific investments with specific tickers. It might help you in rebalancing. You might start at the asset class level, but then as you decide on the ETFs and mutual funds you're going to use to implement that plan, it can be helpful to just have a plan that says, okay, I want a specific percentage in this ETF and a specific percentage in this mutual fund, and it can just help you understand your portfolio better and help rebalance. But in any event, Empower is a great tool to monitor your performance. It's not the only tool, of course, and I'm actually working on a video that walks through about a half a dozen tools that you might consider for tracking your investment portfolio. Okay, the next one, let's see, number 7. No, this is 6. 1, 2, 3, 4, 5, 6. This is 7. Okay, number 7 is if you own individual stocks, I think it's always worth checking how much you own in those stocks, and are you overly concentrated in a single investment? This is something that I've dealt with our Apple stock. I actually sold a little bit at the end of last year. I plan to sell a little bit at the beginning of this year. For tax reasons, I split it over 2 years, and then I think I'll be down to our comfort level. A lot of folks say don't own more than 5% in an individual company. I don't think I have a hard and fast rule for that. I think for us, we've chosen 10%. The bigger question I think you have to ask is, if that investment goes down by 50% or even more, what's that going to do to my retirement plan, my financial freedom, our financial future? For some people, it might be devastating, in which case I wouldn't have 10%. I wouldn't put my financial future at risk to concentrate in a single position. But for others, you wouldn't be happy if the investment went down by 50%, but maybe it wouldn't really change your retirement plan. So that's sort of how I think about the concentration risk. But However, whatever you decide for yourself, I think at least once a year, take a look at it, see where you stand. Now, if you're using a tool like Empower, as I mentioned before, I mean, you can sort of monitor this all the time, and you'll know as a given position starts to become too rich for your portfolio. Okay, 3 more to go. And this one deals with if you're using a financial advisor, I think it's important for you to understand your fees that you're paying them. And I can't tell you how many people I've talked to that said, hey, I'm using a financial advisor, and I'll ask them, oh, well, I'm just curious, what are the fees? They don't know. And it's not enough to know the percentage, if that's how they're charging you, a percentage of assets under management. Translate it into dollars, and then ask yourself, is it worth it? Is it worth me to have someone managing $1 million for me that's costing $10,000 a year, assuming it's 1%? Does that make sense? I think it's worth evaluating that every year. Maybe for you, the advisor you have and the relationship and the fee structure makes perfect sense. That's great. But maybe not. Maybe you either need to have a conversation with them and or perhaps change advisors. But I think it's so important that particularly the fees have such a great impact on our wealth over time that we need to make sure that we're not overpaying. I think it's worth evaluating at least once a year. Number 9, got 2 more to go. Number 9, make sure you have 2-factor authentication set up not only on all your financial accounts, but this is critical, also on your email accounts. And all 2-factor authentication is, you put your username and password in, and then either through text or email or preferably through an app, you will get a one-time code that is only good for like 60 seconds. And you type that into whatever, it's Vanguard, Fidelity, Schwab, wherever, or at a bank. And you can only get access to your account online or on the app if you use that one-time password. So you've got to really know 3 things: username, password, and that one-time code. And the idea behind it is, if for some reason your username and password were compromised and someone had them, they still would not be able to gain access to your accounts without I'll call it the 60-second code. Really, really important. I prefer to be able to use an authentication app. Google has a very popular one. I prefer that over getting a text message from the financial institution, but depending on where you bank and who your broker is, you may or may not have that option. But however it's set up, 2-factor authentication is critical. All right, the 10th and final one, if you've stayed with me this long, thank you. I always like to ask, and I did this just a month ago or so, I said, how can I simplify? Is there anything I can do to simplify my investment portfolio? Which for me usually means taking 2 or more investments, say ETFs, and combining them into one. So for example, one thing that I did, I had in our retirement accounts 1 fund for US stocks and a separate fund for international stocks. And I decided I was going to sell both of those. It's in a retirement account, so there were no tax consequences, and put all the money in a single fund that invests in both US and international stocks. So it's just one less fund I have to worry about. In fact, I'll show it to you. This is not a recommendation. I'm just showing you what I chose. It's a very well-known Vanguard Total World Stock ETF. Here it is. Very, very cheap. Remember, ARK was 75 basis points. This is only 7 basis points. And we can go to the portfolio, and we can see it invests about we'll call it 64% in US stocks, 35% in foreign stocks. Now, you may say, well, Rob, I appreciate the simplicity, but that's not the allocation I want. Well, a couple of things there. One is that's going to always be the trade-off. As you simplify your portfolio, combining multiple asset classes and funds into one fund, you give up the flexibility of deciding how much, in this case, in U.S. stocks versus foreign stocks, and you have to decide how important that is to you over simplifying your portfolio. I will say that in our taxable accounts, we don't own VT. We still own separate funds for U.S. stocks and foreign stocks, and that's probably not going to change because of the embedded gains in those funds. I have no interest in selling them. But in a way, it's sort of a blessing in disguise because it prevents me from maybe further simplifying our investments in our taxable account, but it allows me to actually change this allocation between U.S. and foreign. This is what it is in our retirement accounts, but because of what we have in our taxable accounts, our exposure to foreign stocks isn't really 35%. It's really closer to 20%. But Again, the key is, can we simplify our investment portfolio in any way? And the thing is, as you get older and you get closer to retirement, if you're like us, you end up with more and more accounts. I started out, I had one 401k. Well, then my wife, had one, and then I had an IRA. Then she had an IRA. Then Roth IRAs came along. We each had one of those. And then an HSA came along, and a taxable account. And so simplifying the investment you have in what can be 6, 8, 10 different accounts really helps. And then once you retire, you're not only dealing with rebalancing. Eventually, you're dealing with required minimum distributions. We're not there yet, but knock on wood, we'll eventually get there. And then you're also dealing with trying to generate a retirement paycheck. There's a lot of moving parts, and so the more you can simplify your portfolio, the easier all of those other tasks become. And so I think it's a really, really important thing to consider at least once a year. So there you go. Those are my 10 ways that we should evaluate our portfolio each year. I'm sure there are many others. In fact, if you have some ideas, leave them in the comments below so we can all learn. And of course, if you have any questions, you can leave those in the comments as well. I'll do my best to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.